stocks staged an impressive rally this summer that received little respect. But with a busy fall ahead that includes the presidential election, third quarter earnings, and the looming fiscal cliff, can the rally continue? And how should you be positioning your portfolio? Here to weigh in are Uri Landesman, president of Platinum Partners, a New York-based hedge fund, Martin Leclerc, founder and chief investment officer of Barrack Yard Advisors, and Paul Dietrich, director of global research and president of Foxhall Capital Management. Gentlemen, welcome to the program. Uri, let me start with you. We've had a mixed bag of economic data as of late. Retail sales picked up this summer, yet manufacturing has weakened, as well as the labor market. What is your outlook for the economy in the back half of the year?
Our outlook is that it's going to be pretty weak. We think it's a very, very tepid recovery at best. We are seeing some stabilization in the housing market, which is positive. I think the jobs picture is very, very uncertain and could turn down again. Most importantly, one of the things I look at for as a predictor of economic expansion is the rate of bank lending going on. It's at a 4-year low, and so it's going to be very difficult to sustain any kind of meaningful growth in the economy if financial institutions aren't willing to lend to borrowers that actually need the capital.
Paul, how much has economic growth been weighed down by uncertainty surrounding the looming fiscal cliff? We've already seen business investment cut back. Do you think it's starting to bleed through to hiring now?
I agree that we're seeing a very weak economy, but I do see two short-term trends that I think are going to be good for the stock market. And it remains to be seen whether it's going to be good for the economy. I mean, first off, we have our elections this year. The German Bundestag, the parliament, has their elections in late October. The Chinese government has its transition to power this year. All three of these major economic powers of China, Germany, and the United States are going to go into 2013, and they're going to be thinking about policies and not politics. And so I see that alone is probably good for the stock market. The second thing is that all three of these governments have decided on a stimulus. I mean, next week we're probably, or in the next few weeks, we're going to find out what Ben Bernanke is doing, but it seems that he's tipped his hat that we are going to have an ongoing quantitative easing. Quantitative easing is a very fancy word for printing a lot of money. The ECB, the European Central Bank, has already announced that it's going to be printing enormous amounts of money to buy back bonds, and the Chinese government has indicated that they're going to stimulate the economy beginning in 2013. This is going to be a huge amount of money flowing into the global economy, and historically when that's happened, they only do it when the economies are weak, but when that's happened, it's been good for the stock market.
All right, Marty, how much of the so-called economic malaise that we're in right now, for lack of a better way of putting it, is because U.S. debt as a share of GDP is presently at 99%? You know, is debt strangling growth?
The short answer is no. The debt is staving off a depression. The policymakers are taking the debt onto its balance sheet to as really just an aftermath of the prickling of the debt bubble that started with Lehman going under in 2008. But what's happening, what's creating the malaise and what's creating the hamper on growth is the consumer. The American consumer right now is paying off their debts. Credit card debt right now is at the lowest level since 2002. It's down 23% since 2008. And the malaise has to do with, individual investors, institutional investors, all investors in the last 12 years have suffered through two massive declines in the stock market, a housing bubble crash, and other sorts of events which have really wiped out the animal spirits.
Right, so monetary policy has been a significant driver for the markets, Paul, as you mentioned. So I want to talk about the Fed, and then I want to talk about the ECB. Yuri, is QE3 a good idea or a bad idea? We've seen loose monetary policy for some time now, but yet growth, employment has remained anemic.
Yeah, I think it's a terrible idea, frankly. At some point, they're going to have to stop printing money, and this economy is going to have to stand on its own legs, whether that's consumer confidence or enterprise confidence. I'm not sure which is going to eventually lead us out of this. But this has been going on for 3 years longer than anybody originally predicted it would. And there's really only so much there. There really is a chance of creating a financial crisis from just the continued quantitative easing going around the world. And for instance, in Europe, it would be much better if those countries would stop their entitlement programs and really make the changes that they need to do, as opposed to having the central banks currently bail out the Italian and Spanish banks like they did the Greek banks, and who knows who will be next. I just think that the Feds around the world are acting irresponsibly, and it's what the politicians want, because they don't have to then tell the people that they need to spend less money and work harder. But it's the latter that we really need in order to have any sustained economic growth and to finally stabilize the financial system that's really been teetering for the last 5 years.
Yeah, I want to get back to the ECB in just a moment, but Marty, how much do you think QE3 would boost employment? Fed Chairman Bernanke has said that collectively QE1 and QE2 has created more than 2 million jobs, though he does admit that with each installment, the impact becomes less. It seems to me we need a lot more than monetary policy to bring employment back.
Well, it's hard to know exactly how many jobs will be created. To the earlier point, and I think what you're getting at, is we've been here before in terms of too much debt, and the model that we're using in my firm is really from the late 1940s to the late 1960s. And during that 20-year period, and going out 10 more years beyond that to the early 80s or so, debt as a percentage of national income in 1948 was 120%, so it was worse than it is now. And what the policymakers did then, which is very similar to what they're doing now, it's a fancy word for it's called financial repression, but essentially it's having the savers subsidize the debtors to make debt more palatable. And I think that's what's going on and has to go on, otherwise we'll go back into a depression.
It has to go on. Paul, do you think the Fed should continue to pursue these unconventional monetary measures, or do you think monetary stimulus is tapped out at this point?
Look, the Fed doesn't have a choice. I mean, so long as politicians are going to be deficit spending, the Fed has to fund the U.S. government. And I think the most important question that nobody's asking is, how do you pay for all of these deficits? Either the 50% of Americans who pay taxes are required to pay off that debt, or you deflate it, which seems to be what both the Republicans and the Democrats are planning to do, which is we just print more money. So I don't see that there's any question here of what's going to happen, and I would only tell investors that you better get into some hard assets like gold or gold mining stocks in order to protect yourself in the long run.
All right, gentlemen, let's turn to zero interest rate policy, since we are on the easy money subject here. Uri, the Fed says rates are likely to remain at zero through 2014. There's talk about accommodative policy past that. Do you think we're stuck at zero interest rates? And if that is the case, what does that mean for the economy, the market? In my mind, Japan comes up.
Yeah, I mean, I think it reminds you of Japan a lot. The demographics here are slightly different than Japan. So one of Japan's problems, is the age of the population and how few active workers they have versus their retirees. But clearly, having a zero interest rate environment, as long as they did, has proven, disastrous for that economy. And there's no reason that it won't be for us. And that's, one of the reasons why I'm so against quantitative easing.
You think we're on the path there?
Say again?
You think we're on the path to Japan then?
I mean, I think that we are, if not on an identical path, on a similar path, yes.
Marty, would you weigh in here?
Well, yeah, I disagree. I think two things. One is our demographics are nothing like Japan's. Japan is a closed society, and the millennials are coming behind the baby boomers, and so we have actually not bad demographics in this country starting in the latter part of the teens. The other thing that we have on the bullish side long term is this energy independence thing that's going on. We are going to have, as part of this explosion in the energy production in this country over the next 10 years, opportunities in the industrial sector that we haven't seen for 50, 70 years. And that is an extremely bullish long-term trend, which is something that Japan does not have up its sleeve.
Okay, switching gears here. Marty, what's your outlook for third quarter earnings? Are you worried that slowing global growth could hurt earnings for multinational companies? We've already seen Intel warn. We've seen FedEx bring their forecast down.
Well, clearly the slowdown in Europe and the outright recession, actually, and the slowdown in the growth in China and elsewhere, Brazil and Indonesia, is having an effect. I saw a statistic that was put out by Steve Roach at Yale that since the beginning of 2009, 40% of our GDP growth has been in exports. So it will be a factor.
Mm-hmm. All right, let's talk about the market. Paul, last time I had you on the show, you were pretty bearish, but you've actually changed direction. You're telling me now that you're bullish for the next year. Is that correct?
Yeah, I actually think that if you look at a combination, and again, I don't necessarily, you have to make a distinction between the economy and the stock market.
Right.
But since there now seems to be a confluence of ideas that all seem to be similar among central banks in Germany, the United States, and China, there is going to be stimulus, even though I agree with Uri, it's probably a disaster in the long run. It will be positive for the stock market in the short run, seeing all that money flood into the market. We know what that does to the stock market.
Uri, stocks, U.S. stocks are at multi-year highs. At the same time, China's Shanghai index is flirting with multi-year lows. Is that a major warning sign for U.S. stock investors?
Yeah, I mean, I think it is. There are some reasons for the disconnection. Obviously, the forecast for Chinese growth has probably gone from 8% to 7%, which surely isn't helping a growth-oriented stock market. We actually think it could come in as low as 6%. I think that's a short-term problem, not a long-term problem for China. And China is pretty attractive down here. The U.S. obviously seeing a lot of asset flows out of other asset classes is the big reason why the U.S. stock market is up here. But I'm very, very negative on the U.S. stock market. Up here, the S&P is trading at 1436. I think you're maybe talking about a maximum of 70 points of upside here and 250 points of downside. So horrible risk reward in the U.S. stock market, both because of the disconnect with other global markets like China and just because of valuations, given a very, very uncertain economy.
Yeah, Marty, you actually think that U.S. stocks are pretty pricey in the short term as well. You're actually finding opportunities in Europe, even though there's a recession, even though the outlook is miserable.
Well, I like to follow the misery. Yeah, we haven't bought a U.S. stock in about 3 or 4 months, I guess, or been excited about one. The case for Europe is that they have world-class companies that are selling on the cheap. If you take the CAPE, which is a cyclically adjusted price-earnings ratio, which measures the long-term valuation of stocks, American stocks right now are sort of not expensive nor cheap, somewhere in the middle to higher end of its historical range. But European shares are at its early 1980 levels, and that was early 1980s was a good time to buy stocks.
All right, well, let's drill down a little bit further. What names specifically, where are you finding opportunities in Europe now?
Well, I have a blue chip name, which is Tesco's, which is the British retailer. And the UK, I lived there for 9 years, and I can say one thing about them is that it is a nation of shopkeepers. And Tesco is one of the world-class shopkeepers. They've been in business for a long time. They've raised their dividend every year for 27 years. That dividend's over 4.5%. But the big thing about Tesco, and it's trading like 10 times earnings, the big thing about Tesco is that it's an emerging markets play. 10 years ago or 11 years ago, they had no businesses in South Korea, and organically, they've grown their South Korean business so that this year they'll be doing over $8 billion in sales. So it's a good play.
Paul, where are you finding opportunities now to round us off?
Well, I do like China. I have a little bit different view on China. For the last 3 years, central government policy has been to try to slow the economy down from what almost everyone agreed were unsustainable rates to this 6 to 8%, of which the government believes is a sustainable rate, and I agree with them. They've been successful at that. The stock market over the last few years has dropped substantially. It's at historic lows. I think there are real bargains to be had in China, but I'm looking at companies that people have to have. You know, they will give up other things in a slowing economy in order to have this. And you have to remember,
what names?
like CNOOC, which is the oil company, you know, their auto sales are still 20 to 30% greater than ours here in the U.S. And Chinese people, they want to take road trips the minute that they get a car, and so I see oil demand going up. CNOOC's the play. China Mobile, everyone has cell phones. Nobody has landlines anymore. China Mobile, they're also now really getting into data sales, and so that's a whole new big revenue source. And there's another company called Television Broadcasts, which is actually out of Hong Kong, but it's sort of the direct TV of Asia, and it's one of my favorite stocks.
Gentlemen, thanks so much to all three of you for coming on the program and sharing your insight. I so appreciate it and hope to see you all soon.
Thanks.
Great, thanks.
Thanks.